Hi, Dr. Dolly. First, I wanted to say thank you for playing a huge role in my financial literacy and also getting me on track after making a few financial mistakes early on in my career. So, my question is in regards to asset allocation and how it changes as we get closer to our retirement date. When do you consider changing the allocations in your different accounts when you're 20 years, 10 years, 5 years away from your retirement time? Thank you for all that you do and look forward to hearing from you.
Okay, Jason's basically asking, how should your asset allocation change as you approach retirement? And there's no Bible on this topic, right? Everyone's got an opinion, and nobody really knows whose opinion is right. Because in the long run, the more aggressive the asset allocation, the more likely it is to have higher returns. But at the same time, your ability to tolerate fluctuation and volatility of the value of your portfolio is lowest around the time of retirement. This is known as sequence of returns risk. And the idea is that your returns in those last few years of your working career, your accumulation stage, and the first few years of your retirement or your distribution phase are much more important to your overall lifetime portfolio performance than any other years. And so the idea is to have those years be a little bit less volatile. Some people call this a bond tent, right? And so they increase the percentage of bonds for 5 years before retirement or 5 years after retirement. Other people, set a formula up in advance that every year of their career, they're going to go down in their stock to bond ratio by 1%. So maybe they start out at 75-25, and each year they go down to 74-26, 73-27, et cetera, year by year until they get to the retirement date. And it's fine to have that written into your investment plan as well. I think that's the key, though. Just pick a plan, something reasonable, and put it into your investment plan. Thus far, I've basically kept my portfolio static throughout my career. Basically 60% stocks, 20% bonds, 20% real estate, and that works for me. I may just carry that on through into retirement because I'm pretty tolerant of it. I've got more than I need. I can tolerate the fluctuations. And so you may just choose a static portfolio as well. But I think the key is to write it down, put it in your investing plan, and follow it. Keep in mind, Jason, you mentioned how do you change your asset allocations in different accounts. My recommendation is you look at all your retirement accounts, all your money for retirement, even if that includes a taxable account, as one big portfolio. And so you're not necessarily changing each account's asset allocation in response to age. You just want to change the overall asset allocation as needed. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.